For the first time in 9 months, the Federal Reserve just pulled the trigger. Interest rates in the United States were cut from 4.25 to 4.50 down to 4.00 to 4.25. It's only a quarter point, but in finance, a move this small can feel like an earthquake, because when the cost of money changes, everything changes. The rules of debt, the rhythm of markets, even the way families plan their future. And while most people just see a headline on CNBC, the wealthy see a signal, a green light, a moment that can launch fortunes or sink the unprepared. The Fed's decision wasn't random. It was a carefully calculated move. After holding rates steady for 9 long months, Jerome Powell and the FOMC voted to ease just a little. The new range is 4.00% to 4.25%. Not the lowest we've seen in history, far from it. But compared to the aggressive hikes of the last few years, this is a noticeable turn. Think of interest rates like gravity in the economy. For months, gravity was heavy. Borrowing money felt like climbing a hill with weights strapped to your legs. Mortgages squeezed households. Credit cards drained budgets. Businesses held back from expanding because the cost of capital was too steep. Now, with one small cut, the Fed just loosened that gravity. It didn't make the hill disappear, but it tilted the slope ever so slightly. And in finance, even the smallest tilt changes the entire race. Markets felt it immediately. Stocks perked up, bonds shifted. Even Bitcoin caught a spark. Because investors know when the Fed changes course, money starts moving differently. But here's the catch. This was only the opening act. The real story is why the Fed cut, what it signals for the months ahead, and how you can turn this into opportunity instead of just background noise. The Fed doesn't wake up one morning and decide to cut rates for fun. They do it when the signals are too strong to ignore. For the past year, inflation has been cooling, not gone, just easing. From the painful highs of 2022, price growth has slowed. Groceries aren't skyrocketing like before. Gasoline isn't punching wallets every week. But inflation is still above the Fed's 2% target. That's why they held rates high for so long, to make sure the fire was really under control. But here's the problem. The medicine was starting to hurt the patient. The job market, once overheated, is showing cracks. Unemployment claims have ticked up. Companies that used to hire aggressively are slowing down. Some are freezing positions. Others are quietly trimming staff. That's the first whisper of a slowdown, and the Fed can't ignore it. At the same time, economic growth is losing steam. Businesses are cautious. Consumers are stretched thin after years of higher prices. And with borrowing costs so high, both sides, households and companies, have been holding back. So the Fed is trying to walk a tightrope. If they keep rates too high for too long, the economy could stall. If they cut too fast, inflation could flare up again. That's why this first cut was only 0.25%. It's not a floodgate, it's a pressure valve, a way to release just enough tension to keep the system from cracking. Think of it like opening a window in a stuffy room. You don't throw the doors wide open, you just let in a breeze, enough to see how the air changes. But make no mistake, this is the first pivot. After 9 months of silence, the Fed has started moving again, and the markets know it. Because once the Fed changes direction, the question isn't if more cuts are coming, but how many and how fast. When the Fed moves, the economy reacts like a chain of dominoes, and this cut, even if small, is already tipping the first pieces. For households, the impact starts with debt. Credit card interest, car loans, personal loans, all of them are tied, directly or indirectly, to Fed policy. When rates fall, that crushing monthly payment can shrink just enough to give families breathing room. A mortgage that once felt impossible may suddenly slide back into reach. An adjustable rate loan resets a little lower, shaving dollars off the bill. It feels like relief. And for many families, that relief is real. It's the difference between treading water and finally catching a breath. For businesses, the cut is oxygen. Companies borrow money to grow, to hire, to launch new projects. At higher rates, that growth is choked off. But with cheaper borrowing costs, boardrooms across America start running the math again. Projects that were shelved last quarter might suddenly get the green light. Expansions that looked too risky might now move forward. On Wall Street, the reaction is even faster. Stocks jumped within minutes of the announcement. Why? Because the value of future profits rises when the cost of money falls. Bonds adjusted, yields shifted, and investors quickly repositioned. Even alternative assets, gold, crypto, real estate, felt the pulse. Because when the Fed cuts, capital doesn't sit still. It looks for the next place to grow. But here's the part most headlines don't tell you. Not every impact is positive. There are trade-offs. Lower rates mean cheaper debt, yes, but they also mean lower returns for savers. Those 5% CDs and high-yield savings accounts that finally gave conservative investors a break, they'll start sliding down. And for retirees or anyone relying on fixed income, that race they enjoyed in 2024 may now shrink back again. Lower rates can also reignite inflation if the Fed miscalculates. Cheaper credit fuels spending. Spending pushes demand. And if supply can't keep up, prices start climbing again. It's like giving the patient medicine for one illness while risking a flare-up of another. So this cut is a double-edged sword. It brings relief, but it also carries risk. For the average person, that's where the danger lies, mistaking short-term comfort for long-term safety. Because while one group celebrates shaving a few dollars off a credit card bill, another group, the wealthy, is already repositioning entire portfolios, refinancing at scale, and locking in opportunities that could pay for decades. One rate cut doesn't rewrite the story, it just turns the page. The Fed is signaling that this may be the beginning of an easing cycle, not the end of one. Their own projections, the famous dot plot, suggest 2 more cuts could come before the year is over. But nothing is guaranteed. Every decision depends on the data: inflation, jobs, and growth. Here's the balancing act. If the Fed cuts too aggressively, inflation could flare back up. Imagine pouring gas on a fire that isn't fully out. The flames could rise again, fast. And prices that finally felt stable could spike once more, hitting consumers hardest. But if the Fed cuts too slowly or not enough, the economy risks stalling. Companies pull back, unemployment rises, households tighten spending, and suddenly the soft landing everyone hopes for turns into a hard recession. This is the tightrope Jerome Powell is walking. On one side, inflation that still lingers above the 2% target. On the other, a labor market that's softening, with growth losing momentum. Step too far in either direction, and the entire economy could wobble. Markets are already betting on the future. Traders are pricing in more cuts. Stocks are moving as if cheaper money is a sure thing. But history shows the Fed often surprises. Sometimes they pause when everyone expects action. Sometimes they move faster than anyone predicts. And here's another risk: bubbles. When money gets cheaper, risk assets heat up. Stocks surge, housing demand spikes, crypto rallies. But easy money can fuel speculation. And bubbles, once inflated, always pop. So what comes next? It depends on how you see this cut. For some, it's just relief, a lighter bill, a temporary break. For others, it's the opening bell of a new cycle, the first chance to position before the real wave begins. Because in every rate cycle, there are 2 types of players: those who react late and those who prepare early. So what does a Fed rate cut really mean for you? It's not just a headline for Wall Street. It's a direct signal for how you should move with your money. Step 1. Debt. If you carry credit card balances, car loans, or personal loans, this is your opening. Lower rates mean interest costs ease up. It's like carrying a backpack that just got a little lighter. Now is the time to pay down or refinance, because every percentage point you save is like giving yourself a raise without working extra hours. Mortgages matter too. If you're in an adjustable rate loan, this cut could mean hundreds of dollars less per year. If you're planning to buy, cheaper borrowing makes home ownership slightly more affordable, though rising demand can push prices the other way. Step 2. Savings. High-yield accounts and CDs that recently paid around 5% will start sliding down. That means leaving money sitting safe won't work as well anymore. For retirees or savers, this feels like a pay cut, which is why repositioning your cash matters. You can't just coast on high yields when the Fed is cutting. Step 3. Assets, stocks, housing, and even crypto often surge when rates fall. Cheaper money makes risk-taking easier. But here's the mindset shift. Don't just chase the hype. Position with strategy. Think long-term. Sectors like technology, real estate, and consumer goods usually thrive when borrowing costs drop. But not every stock or coin will win. Choose carefully, diversify, and let the cycle do its work. Step 4. Build reserves. The wealthy don't go all in at once. They keep dry powder, cash set aside, ready to strike when opportunities appear. For you, that doesn't have to mean millions. Even a few $1,000s ready in an emergency fund or brokerage account can mean the difference between watching opportunities pass or grabbing them. Because here's the truth. Every rate cut creates two groups. One celebrates shaving a few dollars off a credit card bill. The other locks in assets, refinances smartly, and positions for growth that compounds for decades. Which group will you be in? A rate cut isn't just a number on a chart. It's a turning point. Because when the cost of money shifts, the entire playing field tilts. And in that moment, wealth doesn't vanish or magically appear. It moves. It flows from the unprepared to the prepared. Most people see a headline and feel temporary relief. Their credit card bill shrinks a little. Their mortgage payment eases. And they stop there. The wealthy? They see acceleration. They refinance portfolios. They expand businesses. They buy assets that will compound for decades. They don't just react, they position. That's the shift you need to make. Stop treating Fed meetings as background noise. Start treating them as one of the most powerful signals in the financial system. Signals that tell you when to defend, when to expand, and when to strike. Because money doesn't wait. Capital flows to whoever is ready. And when the window opens, it never stays open forever. Interest rates are like gravity. When they rise, everything feels heavier. When they fall, momentum takes over. The Fed just loosened that gravity for the first time in 9 months. The question is, will you let this moment pass as just another headline? Or will you use it as your green light to move faster, lighter, and further than you thought possible? Every dollar you save today is a silent worker that never clocks out. And every decision you make in moments like this decides whether those workers crawl or sprint. If this video helped you see the game differently, hit like, subscribe, and share it with someone who needs this mindset shift. And tell me in the comments, do you see this rate cut as relief or as opportunity? And if you want to go deeper, don't stop here. Click on one of the videos on your screen right now. Each one will take you further into the strategies, history, and mindset shifts that can change the way you build wealth forever.